The Bank of Canada's recent decision to maintain its overnight lending rate at 2.75% has generated mixed reactions across the real estate sector. Following a pause in rate cuts after a series of reductions over the past year, industry professionals express cautious disappointment, as many had anticipated further monetary easing to stimulate market activity. Economic uncertainty and market sentiment. Christopher Wine, Chief Operating Officer of Equiton, emphasized the need for an additional quarter-point reduction to bolster consumer confidence, which currently sits at a decade-low level. With persistent economic headwinds, including U.S. tariffs on steel and aluminum, the central bank faces a delicate balancing act. Given Canada's role as a key supplier to the U.S., these tariffs introduce downside risks to economic growth, influencing the Bank of Canada's cautious stance. Implications for borrowing and investment. While the hold-on rates maintains the status quo, money markets are pricing in at least 2 more cuts by year-end, which could provide relief for commercial real estate investors and borrowers with variable-rate mortgages. However, property sales remain sensitive to longer-term financing costs, and potential inflationary pressures from tariffs may drive bond yields higher, offsetting some benefits of lower rates. Housing market slowdown. Economic uncertainty has already impacted pre-construction home purchases, contributing to stagnation in key markets. For instance, Toronto's housing sector saw a 4% decline in average sales prices and a 13% drop in transactions, a trend reflective of broader hesitancy among buyers. Phil Soper, President and CEO of Royal LePage, underscores the importance of policy stability amid global trade tensions. Meanwhile, analysts at RBC note that a softening labor market and cooling housing demand could justify future rate cuts, though recent data suggests a measured approach. Looking ahead, potential for further easing. Should inflationary pressures subside, the Bank of Canada may consider a rate cut as early as July to alleviate economic strain. However, as Jordan Kemp of Greywood Developments highlights, external factors, particularly trade policy, complicate the outlook. Key takeaways for investors. Monitor upcoming rate announcements for signals on monetary policy direction. Assess borrowing costs, especially for variable rate and long-term financing. Stay informed on trade developments, as tariffs could influence inflation and bond yields. For stakeholders in Canadian real estate, the path forward hinges on central bank policy adjustments amid evolving economic conditions. Keeping abreast of these shifts will be critical for making strategic investment decisions. Stay tuned for further updates from the Bank of Canada and expert analyses on housing market trends. Your next move could depend on it. This version maintains a professional, authoritative tone suitable for a video script, ensuring clarity while incorporating key economic and real estate insights. Let me know if you'd like any refinements.